Hello everyone, welcome to our first part of our discussion of Chapter 6. We'll actually have three videos or podcasts on this chapter, breaking it into three parts with a part just for depreciation. So we jump first in here to talk about how we report income from a business activity. There's a Schedule C, and you'll hear that referred to all the time in tax preparation professional circles. Always referred to as a Schedule C, and this is attached to the 1040. This is for any business, any activity that is engaged in for profit. So the intent needs to be to make income. That does not mean that it has to make income. It just means that the intent needs to be there to be income. And if you want it to be a business and it doesn't make income, meaning the expenses are higher than the revenue that you bring in, then you need to realize that you're going to have a harder time proving to the IRS that it's a business and being able to deduct those expenses. We'll talk about hobbies a little in the third video, but the alternative is if it brings in just a little bit of income, but it's not intended to make a profit, then it's then it's a hobby. And therefore, the expenses cannot be deducted to exceed the income. Now, if it's a legitimate business, you intended to make profit, the more years it goes without making a profit, the harder it is to be able to justify that it is a business and not a hobby. Especially if there is some element of personal fun in the activity. There are certain activities that are almost never going to be considered to be hobbies, just because they don't have any what most people would think of as fun, even if they lose money year after year. However, IRS could still challenge them on the basis that it was never intended to be made profitable. But if the intention is to be profitable and you do the things that need to be done to run it like a business to make a profit, then the reporting is done on Schedule C, like you see here in front of you. Okay, so this is filled out by putting the information about the business up top, choosing the accounting method, okay, saying you participate in this business, and then you have your income coming in, you subtract cost of goods sold, get gross profit, just like an income statement you've done in other accounting classes. And then your expenses are some here that are listed specifically, and then there's a place for others. So this doesn't have to be all of them. Okay? The total expenses subtracted, and then you put your net profit or loss. If you make money a couple of years at your business, meaning it shows a profit, then it has a year where it loses money. That it's pretty easy to explain. It's when there are multiple years, there's no profit, and multiple years of losses that we get to have a problem. And we're going to actually do a little research assignment about what that might entail and what goes into that, proving that things are a business. So what would be reported on this? Okay, of course, typical business receipts, right? Direct sales to customers, work performed as an independent contract. That's where we get a little bit of a challenge sometimes when we have done something um, as an independent contractor and been paid by the contract, not by the hour, not by on a W-2 or regular paycheck, but because we did a project for someone. That's an independent contractor. You may or may not think of it initially when you did it as being an actual business. But if that is something that's happened even once or twice, maybe multiple times, then there's really no other place to report it except for Schedule C. All right, statutory employees are usually salespeople who are treated as employees for certain things, but treated as report their income on the Schedule C. More advanced than what we want to talk about, but just so you understand that there is that category as well. Typically, independent contractors get a Form 1099 NEC if they're individuals and if the people that you do the project for are a business that has to send a 1099. Okay? Very familiar terminology, cost of goods sold. Typically, small businesses, those that are reporting on a Schedule C, are going to use the cash method of counting, except for if they have inventory that is a substantial amount of their business. Then they have to use accrual for inventory. They don't have to do it for the rest, but they have to do it for the inventory, meaning they can't take a deduction for the cost of everything they bought, even if it hasn't been sold yet. They have to track their inventory, or at least give it a go at tracking the inventory. They can use cash payments for everything else on the Schedule C other than inventory, but they got to use the inventory if it's a major part of their business, even if they're small. But if they are making a lot of money, in this example, gross receipts are more than 30 million, you have to use the accrual method, not just for inventory, but for everything. Okay? So that's quite a bit of money. Most people would not consider something 30 million as a small business anymore, but technically it still is, and would need to move to the accrual method. So what can we deduct as a business? People have commented, thought about, argued over this. There are court cases, there are regulations, all kinds, because there's no real way to put a list together of every single expense you might need to use for your business. So when the dispute ends up in court, or the IRS is fighting with a taxpayer about whether something is deductible or not, they always go back to the three words here: ordinary, necessary, and reasonable. Okay, so ordinary means it happens all the time. Necessary means it was needed for the business. Okay, it doesn't have to be essential, but it's got to be helpful. It's got to be something that made the business happen better. Okay, and it can't be so big compared to what the benefit they got that it's unreasonable. So it has to be reasonable. Those are the three things. They can always come back to that. So that's what the IRS is going to argue. All right, is that those three, and to show that that these three are in place, you're going to need some receipts. You're going to need some, uh, evidence of payment so that you can show, because without evidence, you're not going to be able to show that it was ordinary, necessary, and reasonable. And without that definition, then it doesn't become deductible, because deductions have to fit this or they're not deductible. That's the general rule. Is you have, as a taxpayer, the burden of proof, as your business, the burden of proof to show that you paid for it and that it was these three things. Now, there are some things that are specifically said it is not deductible. And while there are some important ones here, it's not a long list. These are forbidden. Anything illegal, whether it was necessary, whether it was ordinary, doesn't matter. Bribes, kickbacks. Doesn't matter that everybody's paying the bribe or kickback. It's still non-deductible. If you're paying for lobbying, okay, or anything to a political candidate or anything like that, those are all non-deductible expenses. It's not forbidden in the sense that the tax law says you're going to jail if you pay them. The tax law says you can't deduct them. Somebody else may be after you because they're and put you in jail for bribes and kickbacks, but the IRS is not going to. Okay, fines and penalty payments are the other one, because fines usually mean you did something illegal or against the rules some way. It may have been not a big deal, but the standard is if you paid a fine. Parking tickets are a perfect example. Okay, it doesn't matter that it was in a business purpose and that you were seeing a client when you got that parking ticket. According to this forbidden expenses list, that's a fine for parking where you shouldn't have. And because that was against the law, then the IRS, or basically the tax law, says we can't give you a deduction for doing something wrong and having to pay for it. Okay? So penalties for pollution or something like that, none of those are deductible, no matter what the situation is. Okay? So that's the basic idea of revenues and expenses for your small business on a Schedule C. In part 2, we're going to talk about all the ins and outs of depreciation. That's going to take a little while because that's the hardest of all these expenses to understand for most people. And then we'll get into some other, in part 3, some other expenses that have some kind of, what you might not expect in terms of the rules.